CVL, Company Voluntary Liquidation. If you're considering a CVL, you've probably reached the stage in your business where you're fearful that it cannot continue, you're worried about your future, and no doubt you're getting a lot of creditors that demanding payments from you. It can be a horribly scary time. I think what you probably need to consider is looking at the business, whether it can continue. If you believe it can continue trading, have a look at the CVA video that we posted previously. That's a way of continuing to trade with your creditors. If you believe you've reached the stage that the business cannot carry on any longer, it's just reached the end of the day and the creditors will never get satisfied, consider a CVL. Working with a qualified liquidator, it's a good way to remove the business, close the company down, and look at trying to settle any liabilities in the best way fashion you can. Ordinarily, when you get a CVL, the first thing you need to do is talk to your accountant. They will help you prepare exactly where your business stands. Look at the creditors, look at the debtors, look at the financial stability of the company. Then start to engage with a liquidator. By working together with all three parties, you'll find that you have the best chance to remove the company with the least headache for you. By just ignoring this and allowing it to carry on, it can start to hamper your personal credit rating and obviously the company credit rating. And again, that should be avoided because then you end up in a position where you could end up owing money to HMRC or other creditors if they believe that you have gone beyond the means of the business itself. If your company is trading insolvent or illiquid, again, definitely get in contact with the liquidator. You don't want to be trading as an insolvent company. HMRC deemed that against the law, and without scaring anyone, clearly there's a better way to deal with this. So, points to note here. Contact your accountant, get them bought into the process. They'll be fearful for getting their fees if there's anything outstanding, but they're qualified, they're professionals, they have to help you. Then contact a liquidator. Look at any ways you think you can afford to repay the liabilities. So whatever the liabilities are within the company, typically when you go through a company voluntary liquidation, you'll find that the debts would then be agreed at a level. Again, if we had £100,000 liability, it's hard to say what would be agreed because you'd need to look at the individual creditors. But typically, the overall amount a liquidator would agree would be anywhere between 30 and 100%. Now, 100% is unlikely, but things you do need to consider as part of this journey is something called a DLA, Director's Loan Account, which I'll explain later on. Director's Loan Accounts are where you draw money from the company when the company doesn't have the funds to pay you salary, dividends, or expenses. And if we've reached that stage, then the company itself has actually funded you in what's called a loan. Now, HMRC don't like that. And equally the creditors don't like that. So that's when you get in a position where more money may have to be repaid. But again, working with a liquidator, they can help you to analyse everything, look at what you have spent money on, what we can re-tag as salary or dividends, and then start to work out how we can get you in a position where you're not as bad off. That's the CVL.